On this episode of The Capitalist Investor, for decades, the 60-40 portfolio, 60% in stocks and 40% in bonds, was the retirement recipe for your investments. But then it died, and then it came back to life, and then it died again. Is it going to be coming back to life when the Fed cuts rates here in the near future?
Hey, Tony, what's going on, man? How you doing?
What's up, man? How you doing?
Back from vacation.
All right. Is that a new shirt?
It is, yeah.
Did you golf there?
I did, yeah.
You dirty dog.
Remember, I've
the Ocean
I
Club
missed you. I wish you were there with me.
In the Bahamas.
Yeah, it's one of the greatest places ever, honestly.
Oh, dude, the one hole, like the whole left side of the hole is the ocean, and it's like a big sand trap.
Yeah,
that's not. Anyway, good for you. I'm happy. Should have bought me a shirt. Thanks. All right, today we're going to be talking about the old golden standard of having a balanced portfolio, walking into or preparing for retirement or in retirement, the old 60-40, right?
Yep.
60% to stocks, 40% to bonds. However, the bonds were so good in like the 90s, early 2000s, things like that, when we were cutting rates, right? And we're cutting rates, and when interest rates go down, your bond asset goes up, right?
Yep.
Okay.
Started January in 2001. You were looking for that.
And then we had zero interest rates forever, and bonds were flat. You call them dead or flat, but I mean they weren't yielding much and they weren't growing. And now that we then spiked interest rates right after, like once inflation went through the roof, and we had to tame inflation with increasing rates. That's what the Fed did, right? Bonds cratered. And what was it, in 2003 I believe it was, there's less than a handful. Like there's 1, 2, or 3 times where stocks and bonds were down in the same year. We got to experience that little treat in 2003. Or 2023, sorry. And I mean, there was nowhere to hide.
Yep, 22.
Was it 22?
Yep.
Okay. Sorry.
That was the rough year.
That was the bad year?
Yep.
Okay. And now we could argue where it's like, hey, like, I don't want any bonds. They're not doing anything. I'd rather just have growth stocks. And, people are they're hearing everyone, all their friends making money. I'm like, oh my God. I'm like, the market's doing well. And it has. Don't get me wrong. But are bonds going to become a darling again? Because the Fed is looking to cut rates. There's immense pressure by President Trump on the Fed chair to do that. And are we staring at a nice bull run in bonds, where the 60-40 portfolio could actually be a nice 1-2 punch again?
Yeah, for sure. I remember coming out of the 2008 recession. It was kind of the global financial crisis. It was kind of the perfect storm. The market was collapsing, but also people were moving all of their money to bonds because, back then there wasn't really that was just kind of the move people were making, not really any advanced maneuvers, just out of equities into bonds. And I remember, it was double line. It was throwing off like, 8-10% return per year, just like crazy numbers. You could just throw your money into a bond fund and have a huge headwind for that 60-40 portfolio. I think 2022 really did change a lot of people's minds because the 40%, the supposedly safe part, didn't really do anything. In fact, it actually hurt the performance, in a big down year for the S&P. I think it was almost down 20%. I want to say like 18% in 2022.
Yeah.
So, that's why we've done so many shows on, alternatives to the 60-40. But
yeah, like we talked about private credit, alternative income, right? Like catching a bond that isn't really in a bond market. It's like what businesses are paying to small private equity funds that are loaning them money,
right?
Which are high asset backed, like they could be rather secure, right? So, and then you also have like real assets could take that spot too, like real estate. Real estate's illiquid, but it does usually generate rent, which is a form of income, right? So if you're investing in real estate, collecting the monthly check or quarterly check, depending on what kind of investment you're in, is the equivalent of a bond, or it can be. And so the one thing is that, like, and this is 60-40 is that's how much risk do you want to take? Because I talk to some people like, Tony, I want no bonds. And I'm like, well, that's fine, right? But I still feel, so I've had these conversations with like Mark with some clients, and they're like, Tony, I want nothing to do with bonds. Like, I know they're just not going to make us any money. Maybe that'll turn over. Maybe that mentality will turn over if we start cutting interest rates, and that's a tailwind for bonds to go up. But right now, let's think about it. So another way to combat this is like being exposed to all equities can be detrimental, because the old saying, you buy low, sell high. Well, what happens when stocks go down and you still need income, right? You don't want to sell low, right? Because to generate the retirement income you need. So if you want to be aggressive, like a 60-40 portfolio is a moderate, maybe moderate aggressive portfolio, depending on your mentality. But the book says it's moderate. Right. Aggressive is more like 80-20, or maybe even 100-0. Right. Right. It's in that range of like. But think about this. Another way to do this, if you're more of an aggressive investor, whether you're pre-retirement or even post-retirement, but you're still drawing income, think of it this way. Here's another outlier idea where the average bear market in stocks is somewhere between 2 to 3 years. And that means stocks are down 20% or more. And to get back to even, it takes about 2 to 3 years typically to do that. Now, this year was a little different in 2025. We entered bear market territory, and we're back in 3 months. That's not normal, but we're not in normal times. But in normal times, 2 to 3 years. So let's just call it 3 years. So let's go kind of more on the higher end of that spectrum. And I need 80 grand in retirement to live my lifestyle. We can adjust this number to whatever it is, but like, I'm going to use an example. I need 80 grand and I have $1 million portfolio. Well, of that 80 grand, 40 is coming from Social Security, hypothetically. So I need to pull 40 grand out of my investments every single year. But hey, Tony, I'm all in equities. What if the market does go down? What do we do? I'm like, that's a good problem. Right? Well, you know what? It's not. I mean, it's a problem where we need to come up with a solution. So even though you might want to be, 100 miles an hour, 100% stock, 0%, maybe you need to just take 3 years times 40. That's 120 grand that you need to put on the sidelines in bonds, or even some of these money markets are paying 3.5 to 4%. We use Schwab and Fidelity, but those could be going down again if the Fed starts cutting rates. If they're yielding 4% today, maybe in 6 months they're yielding 3%. Yep. So all I'm saying here is that there's 60-40 is just the old standard from years and years ago. It's the go-to model for retirement planning. If you want to be aggressive, I think you still need to put at least 4 or 3 years of money into something that you can dip into if markets were to go down.
Yep, for sure. And I've used strategies with clients where we stay aggressive on their investment side of their IRAs and brokerage accounts, but we use annuities to basically fill the gap on the income. Yeah. So you have guaranteed income on one side. You figure out kind of what you need, and you can put the right amount in there. So you have a guaranteed income stream. I've been doing that recently, kind of with half like growth annuities and half income annuities for a little diversification.
Yep.
But you can still be conservative, quote unquote, on the income side and aggressive on the investment side.
Right.
Is all you just kind of figuring out your equation. And that I think is probably going to be one of our main points here, is that it is dependent on your situation, but it's also dependent on how much risk you want to take. We always say, time in the market, not timing the market. Making big changes throughout the year, is something that you don't want to be doing, even if you're right? Because even if you're right once, you still have to be right again on the timing. So, getting comfortable with the volatility in your portfolio, is really a major part to retirement and retirement success.
Yep, I completely agree. And yes, another alternative are the income annuities. I'd say like they work like Social Security. We can tie in Social Security. Maybe you have a pension, guaranteed income flows.
Yep.
Right. Where we don't have to necessarily worry about what is happening on the other side of the equation in the equity market, because maybe 70 to 80% of our income needs are taken care of through Social Security and another guaranteed income stream. So, and then the fact that you mix in like the growth annuity, you can usually pull 10% out of those. Great time to pull 10% out is when the market's tanking.
Yep,
right.
Exactly.
So, the key takeaways is, it hasn't hit us quite yet because the Fed has not started cutting rates quite yet. But I do feel that, bonds are going to be looked at a different, a different view that they haven't been in quite a long time, and that it is part of the portfolio again.
Yep,
because
for sure.
they're going to be cutting rates, and that is a tailwind typically for the bond market.
Yep. Yeah. So, to answer your question from before, I do think, I am kind of, I wouldn't say bullish, it is the bond market after all, but rates have to start going down. I believe the market's priced in 3 rate cuts before the end of this year.
Yeah, it's like at least 2.
Yeah.
If it's 3 now, I wouldn't discard it. But I wonder if the first one will be 50. I wonder if it'd be 50 basis points or a quarter.
Yeah.
We'll see. But yeah, I mean, like there's some economic things happening, like unemployment's kind of going back up, inflation is ticking up, but like inflation's been flat for so long, and we're coming off of 9% not that many years ago. Yep. And like, yeah, there's going to be some inflation, but not like, I don't believe it's going to be like it was back when it was skyrocketing into the 6, 7, 9% rates, right? So nobody likes spending more money, but typically when there's inflation, like the stock market keeps up with that and has historically. So
yeah.
So one last take on this is that, you don't want to, bury the idea of a 60-40. I also don't think you want to bury the idea of being 100% in all equities. I think you still need some fixed income kind of component in case the bear market comes through, but just don't follow like what we're saying here blindly. Like, oh, they said 60-40, let's do it. Like, you should have your retirement plan built out. You should have a custom plan based on your income needs, your retirement assets, how all this stuff plays to you, what your retirement goals are. Have the custom plan built, and that is how you determine the appropriate amount of risk that you need so that you can take care of your income needs in retirement.
All right. Well, excellent topic this week on the 60-40 portfolios. And if you guys have ideas for shows or anything you want us to talk about on the show, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.